Hi, and welcome to the Midday Market Update for August 4th, 2020. My name is Kevin Hill, here with Michael Vincent, as always. How are you doing today, Michael?
I'm doing great. Good afternoon, everybody. Welcome to the Midday Market Update. It's a beautiful afternoon. It is. You were about to say it's interactive, right?
That's what they tell me.
I should have let you said that. That would have been more interactive, right?
It would have been.
But it is interactive. So get your questions and comments in on FreightWaves LinkedIn and Facebook, or write them down, shoot them over on a little paper airplane, however you can get them to them. We'll address them as best as we possibly can. We got a good show today, though, don't we?
We do, and this special thing called the internet will send them right to my computer.
That's
a
little bit easier.
It is a little bit easier. Yeah, we have a great show. We're going to go over the news headlines, just the two of us, because Andrew Cox is out on vacation. I think he was near that hurricane.
Was he really?
Yeah, he's on Tybee Island.
Oh, yeah. So he went over there to enjoy the. Is he a surfer? Maybe he's a surfer. I don't know.
He probably is a surfer. Yeah,
it'd be great. It probably was pretty good.
It probably is,
yeah. And then we're going to do the market update ourselves, a freight market update as well, right here at the desk, as Zach and I did last Thursday. But now he's off vacationing.
I know. He was thinking he might get hit by the hurricane, but it went the other way.
Oh, is there another one over there?
No, but it went up the Atlantic side of Florida, and not the Gulf.
Yeah, he went the other way. He went the other way. He was smart.
He was on the Gulf. Yeah, and then we're going to talk economics with our lead or chief economist here at FreightWaves, Anthony Smith, as always. And then after that, we have some great guests coming in.
Yeah, we definitely do. We absolutely do. So who do we got today? We've got, who is it? Richard Sharpe, so CEO of Competitive Insights.
Yes.
Which
it's a software company that manages supply chains and kind of vendor management, customer management, and profitability. So it's all about profitability.
So you bring these guys in, or you utilize their software to analyze your business models, right? For your different SKUs, et cetera.
Yeah, SKUs or brands or whatever, or your business segments.
Right.
The vendors that you use and which ones are the most profitable and which ones aren't. So we're going to talk a little bit.
So it's everything from supply chain, your vendors that you're bringing in your raw materials to, all the way through on-shelf sold items, analyzing
analyzing that entire supply chain.
That's really interesting.
It really is. And we're going to talk about the Pareto rule, which I always love to talk about. That power rule of the top 20% drives the 80% of revenue or profitability or whatever that system is. So.
Yeah, exactly, and that's that's applicable all over the place.
All over the place. You find that
you can find it in sports, in sales teams, in operations teams, in your products, in your vendors. It's a life lesson.
It is a life lesson.
Who else we got today?
Then we have Eric Kulisch, our air cargo markets editor here at FreightWaves, talking about the air cargo market and what the airlines are saying, kind of the role that cargo is going to be playing in this lull in passengers, and kind of what the expected travel recovery might look like from the airline's point of view.
Yeah, it'll be interesting to see. I'd like to hear a little bit more of the strategy, what's going on, because they just approved recently. I mean, not like minutes ago. It's not like breaking news, but within the last couple of weeks, they approved domestic airlines, I guess, to be able to put freight on the upper deck.
Yes.
Right?
Yeah.
And most were thinking at the time, well, it's too late now. Why would we do that? Maybe they're not thinking that right now. I don't know.
Maybe not. Maybe not. It's a fluid situation.
It definitely is.
And then we have some good news after that, and a rundown of what we're doing here at FreightWaves TV.
Excellent. So let's jump into the headlines, man.
Let's do it. What's our top headline today, Michael?
So this one came out from Home Depot this morning. Atlanta, August 4th, 2020. This is from Home Depot, fresh off the press this morning. The Home Depot today announced that it will open 3 new distribution centers in Georgia over the next 18 months to support the growing demand for flexible delivery and pickup options for pro and do-it-yourself customers. The expansion is projected to bring approximately 1,000 additional jobs to the Atlanta area, including full-time and part-time positions. It's really interesting to me that, I mean, here's a huge behemoth of a company, right? And sometimes you talk about these, you can't steer a battleship. It's hard to steer that. Though I've seen some of our battleships from the U.S. Navy, and they can turn on a dime for the size that they are. But here's Home Depot that's really been at the forefront of customer service and innovation, et cetera, right? And they're opening these 3 new up because they see the trend. This trend has been happening for years, right? And now it's really accelerating. So they're investigating and moving into that trend for the straight order, then pickup or home delivery. and it's across different channels. What they're talking about here is let's just get into this. So
It's
Stephanie Smith,
interesting.
go ahead.
Number one, it's interesting. Well, I guess number one, this should be up on FreightWaves.com now. If it's not, then in
it'll
the
be
next
there.
few minutes, the full story from Mark Solomon. But the second part is that Andrew Cox and I and Seth Holm, we really, JP and his team as well, we follow that Bank of America credit card and debit card spending.
Right,
and by
right.
industry.
Yeah.
And we were talking just a second ago about airlines, and they're the biggest losers, hotels.
Yeah.
The biggest winners besides e-commerce, right? Your
Right.
straight e-commerce
Right.
or home improvement. It's consistently been up 25 to 30% year over year spending because everyone's at home. Everyone has some free time because they're not going out. They're diverting that cash that they used to travel with
That's exactly
into
right.
home improvement, which benefits Home Depot.
So along that line, real quick, when you're looking at that credit card information, the credit card information coming, because I was reading about Visa yesterday, and so they're saying like the actual credit card spending Visa is a little bit soft, or
Yes.
it's a little bit soft, or a lot soft. The point was
gotten much better.
that the Visa debit cards are through the roof, indicating that people are spending what they have and not necessarily taking
Yes.
credit out, right?
Yeah, then that's what you find in the Bank of America, right?
Right.
Their credit card data and
Gotcha.
debit card data. Debit card spending is much higher than credit card spending. Overall, it's recovered. There's been some positive days. I owe Andrew Cox about $3 or $4 because every day it turns positive. I owe him $1.
Wow.
Because I thought it
Hey,
wouldn't
you
turn
guys-
until like September.
Not getting into bets with you guys. You guys play
I know,
for money.
right? So, so we have that going on. But yeah, I mean, you see actual credit card spending's down. Debit card spending is flat to up. And if you go to any stores around here, especially the national stores, there's a coin shortage right now. So if you go across the street to Panera, you'll see that due to the national coin shortage, please pay via card.
Oh, interesting.
So you find
Let's
that
get back
more
on
and more
topic here.
places.
So
But anyway.
so here's the point. Home Depot has added over 5,000 jobs to Georgia, right? In the last 5 years, over 5,000 jobs. And here's 1,000 more that they're bringing in here. Now, the interesting thing about this is, as Stephanie Smith, Senior Vice President of Supply Chain Development and Delivery, says, retail has changed more in the past 4 years than in our company's 40-year history. Customers expect to shop whenever, wherever, and however they want, whether they're buying a hammer or a pallet of pavers. I can attest to that because I did this from them. Built my swing hinge all on pickup and delivery from Home Depot, and it was fabulous. We're investing to meet the changing delivery needs of your do-it-yourselfer and pro customers, whether they're at home, at their job sites, or picking up in the stores. And so it's a $1.2 billion investment to expand its distribution network in 2017 with approximately 150 new supply chain facilities nationwide, with their goal of expanding to second-day or first-day delivery, one-day, two-day delivery to 90% of the U.S. population. I was part of that in a former job as a vendor for them in their floor covering departments, which was quite interesting. It was a couple of years of work there. But the largest of the new Atlanta area facilities, and this is the interesting part, Kevin, it's all interesting, but it's 657,000 square foot in Locust Grove, which will support the replenishment for the stores in the Southeast, right? Now, initial hiring is already on the way there. There's also in Stonecrest, in 2021, they will open a flatbed delivery center, which is specific. I mean, it's do-it-yourself, or you can have a flatbed come to your house, Kevin, or to your apartment, Kevin, if you're going to build a new table or something like that. You could have it delivered flatbed, I suppose, if you want.
We had a startup on 3 or 4 weeks ago that was doing kind of the final mile to
That's exactly
the
right.
e-commerce.
That's right.
And I can't think of their name
That's exactly
off the
right.
top of my head.
So they're covering the fulfillment to their stores to move that inventory quickly, right? Because you go online, if you shop, you can see that, okay, it'll take this, or you can have it delivered to your house or pick it up at the store type of stuff. So they're building that in that flexibility. Then they're hitting more of the construction site and the trades, right? The pro customers with the flatbed, and even the larger for the home delivery of do-it-yourselfers, if you're building something crazy like I did this summer, for the oversized delivery to pro jobs, that's what that is. But then they also have their fulfillment operations in East Point in late 2021. This facility will offer same-day and next-day delivery for the most popular products, and it's primarily ordered by institutional business customers for maintenance, repair, and operational needs. So they're not just attacking one side of it. They've covered all their customers with this investment, right, and this new trend. Very interesting.
That is very interesting. It is, and commerce has retailing has changed quite a bit. It's changed in the last 4 months too.
It absolutely has.
Click it and pick it. Right.
Yeah.
Click it and pick is the new normal.
Oh yeah,
whether it's groceries or Best Buy, Walmart, any of the big boxes, any of the small businesses out there too have adapted to click it and pick it.
Yeah, I mean in my household, grocery. Just looking at groceries, my household, the trip to the grocery store for my wife and kids does not happen anymore. It hasn't happened for months and months, and actually they're loving it. Right,
That's
doesn't
good.
happen anymore. So hey, we've got the hurricane out there.
We do.
Right. Well, actually, I think it's on shore. So as of 8 a.m. Eastern Daylight Time today, tropical storm was moving across southeastern Virginia, centered about 15 miles southeast of, I'm going to butcher this, maybe Tappahannock, Virginia?
I would butcher the hurricane's
Virginia.
name. So.
Maximum sustained winds around the eyewall were measured by hurricane hunters to be about 70 miles per hour. So it's level 1-ish.
Yeah, level 1.
75. A tropical storm force winds extend up to 140 miles, right? And this is moving north. Okay, so it's sitting there. So yesterday morning, the U.S. Coast Guard issued a port condition Zulu. Have you ever been under a Zulu?
I have not. I've heard it, though.
I've been, when I was in my maritime days down in Florida, it happened a few times. So they've temporarily closed the ports of Charleston, South Carolina, Wilmington, North Carolina. They've issued restrictions at other southeastern airports. They anticipate the storm tracking through the mid-Atlantic today and up into the northeast. So they're temporarily shutting down operations at the ports of Delaware Bay and Baltimore. And they also announced late last night that the port of Long Island Sound was going under condition X-ray, which means all self-propelled ocean-going vessels over 300 gross tons and all ocean-going barges and their supporting tugs must immediately report their intention to depart, or they have to remain in port. If desiring to remain in port during the storm, a remaining in-port checklist would have to be completed and submitted to the captain of the port in order to do this. So there's some disruption going on at those ports, and as we get into the market, we can discuss some of that. The disruption.
Wait, you think it's just a day or two?
What's that?
On the southeast ports, do you think it's just a day or two?
Yeah, it's moving
maybe
pretty
disruption.
quick.
Yeah, it's moving pretty quickly. I saw last night on the Weather Channel or something where they were talking about the storm, and they were talking specifically about it going up the East Coast all the way to New England, and D.C., New York, Philly, all having 60-plus mile-an-hour winds.
Yeah,
which is an insane amount for that area of the country.
The most preferred track right now has it going like right up through Philly. Mm-hmm. Straight up through. So it's gonna. And you've got EWR, you've got Allentown, you've got Harrisburg. So truck transportation is going to be disrupted for a day.
It's going to be
60
tough.
miles an hour. It's tough to drive a 53-footer through 60-mile-an-hour winds.
It is. It's very high winds for there. A spring day in Oklahoma where I grew up, that's just a spring day. 60-mile-an-hour winds. It's just like
60 miles.
Yeah, I know, right? It's just like a normal day. But if you've ever driven through Western Oklahoma and saw empty dry vans, on 50, 60-mile-an-hour winds, I've been behind quite a bit.
35-mile-an-hour winds gets tough sometimes.
It does.
Gusts.
Yeah,
it's the gusts
have
really
to,
that nail
a
you.
pickup truck to hold on for dear life.
Yeah.
Yes.
Now run some doubles across the Pennsylvania Turnpike with 60-mile-an-hour winds. Gosh. It's tough enough to negotiate the twists and turns and tunnels, et cetera, on that thing.
I know. And if you're a driver out there,
there's going to be some disruption going on.
Yeah, if you're a driver out there with an empty trailer, be very careful. Which you probably know already. But without that weight, it really just bounces all over the road.
Absolutely. So from the YRC is also on FreightWaves.com. YRC ready to use once-in-a-lifetime loan to replenish the fleet. And the headline comes from this. More than once in its second quarter financial call, less than truckload LTL carrier YRC Worldwide's management team used the words once in a lifetime to describe the opportunity afforded them through a controversial $700 million Treasury loan that the company received in early July, right? We talked about that. It garnered quite a lot of opinions. And
I definitely would agree that it's once in a lifetime. It's a good way to characterize it, really. Once in a lifetime.
Yeah,
$700 million loan.
Yeah. So, the what is it, Tranche B of the agreement? So the excitement largely centered around Tranche B of the agreement, which was granted underneath it, or under the CARES Act, I should say. A $400 million loan allowing it to refresh its rolling stock, right? So management plans to start replacing the old tractors and trailers, obviously, across its entire network, right? But they provided a rough savings. They said it should provide a rough savings estimate of around $10,000 per tractor annually. Maintenance costs on some of the older equipment the company is operating can range from $11,000 to $12,000 a year, which is a far cry from $1,000 to $2,000 spent to keep up first-year tractors moving. $11,000 to $12,000 a year.
That's a lot. And
Yeah,
I think they're going to go into leasing, right? Rather than
I mean,
owning
management
equipment?
believes that the cost headwinds from leasing equipment versus owning equipment is approximately 300 basis points.
So it's 300 basis points more for leasing rather than owning. Okay.
Well, if you got new tractors.
True, yes.
Right.
Yeah,
I doubt there's a 300 BIP difference if you're spending 12 grand on some of that stuff.
Agree.
Hey, back in my day, every spring we had spring cleanup, and we would go to the junkyards and look for parts for our old C800s. We used to run the cab over C800s in a local, and we'd have to go look for stuff. I mean, I had gear linkages that were put together with cotter pins, not cotter pins, but hairpins and whatever we could find to make these. I had, like, in one terminal, I had 12 cab overs. None of them had the same gears.
Figures.
But anyways, so also a good portion of the company's assets don't have the newest technology and lack sophisticated collision avoidance features, which management believes will lower insurance expenses over time. I believe that they're correct if they upgrade those with the proper safety features that are out there and collision avoidance. So YRC plans to phase in new equipment as quickly as possible, but noted it will take 4 to 6 quarters to spend the entirety of the loan, as they will have to coordinate with original equipment owners or OEMs and their build schedule. So YRC hasn't yet used any of Tranche B, which raised some questions on a call as to whether or not the government could pull the deal. Right?
I guess if you want to reduce that risk of pulling the deal, you just go out and spend it as fast as
they can't
possible.
take it back after you spend it. On July.
So and to take one step back, Tranche A is $300 million. I don't know if it's in the article too much, but
it is, yeah.
But just for our viewers out there, Tranche A is $300 million that goes to pay down or off existing debt.
Well, it's deferred health and welfare and pension payments was the majority of it, right? And they've used $245 million of that already to do that. So, so they are definitely on that. And so the CEO, Darren Hawkins, expressed appreciation to Congress, of course, and the administration for passing the CARES Act. It has been a long time since this company has had this much runway in front of us. Amen to that. And we intend to capitalize on every single day, said Hawkins. So there you go. It's a brand new day for YRC.
That is a brand new day. They have covenants in place that they have to hit.
They do.
So they don't have to pay any of it back.
They have a covenant waiver.
They don't have,
right?
Yeah.
And they have more than 3 years before any major debt maturity happens. But they have to maintain liquidity of $125 million.
Yeah.
Liquidity of $125
like
million until $200 million in adjusted EBITDA is achieved. So they have to keep at $125 million liquidity until they reach that EBITDA goal. And the company reported liquidity of $302.6 million at the end of the second quarter, which is not inclusive of the lending agreement.
Okay. So they have plenty of runway.
You would think they have a ton of runway, right?
Yeah.
So there you go. But hey, coming back up. They had great losses in quarter two.
Well, they had better than expected losses, right? Yeah. So they only lost $1.09 per share compared to estimates of was $1.38 per share, $1.38 to $1.66. So they came in at a loss of $1.09. Which beat expectations and Wall Street. So hopefully, it's tiny steps to narrow those losses until you get to profitability. So
100.5 OR in the second quarter this year.
Hey, you're almost there.
I mean, you're almost.
Yeah, you're almost there. Just another 100 pips, and you're at 99.5.
Exactly.
One step at a time.
That's exactly
One
right.
step at a
So
time.
let's see here. It is a new day at YRC Worldwide during this pandemic and historically difficult economic backdrop. We were able to secure financing that not only took care of our employees' healthcare coverage, but also will allow us to significantly upgrade the condition, age, and efficiency of our rolling stock. We were also able to gain additional covenant relief and maturity extension of our other substantive debt instruments simultaneously, said CEO Darren Hawkins in a press release issued to the market at market close on Monday. So there you go, brother.
Good, great. So those are some of the headlines on FreightWaves.com,
They are.
and you can go find these stories and much, much more. We publish about 25 stories from journalists a day. And
There's some good stuff
you
in
know,
here. I mean, we can maybe reach out to some of these a little later in the show or something like that, but head them out. There's some great stuff on Old Dominion and
definitely.
C.H. Robinson
Yep.
on FreightWaves.com right now. C.H. Robinson with its integration into, what's it called? Is it called TaskRabbit? Is that, am I right?
I think so, yeah.
Yeah,
TaskRabbit,
TaskRabbit.
yes.
And what they're doing for small businesses, B2B, small entrepreneurial, through their integration services and their platform. Some really interesting reads there, and some of the expansion of 9 terminals by Old Dominion. Really good stuff. Really
It
good
is,
stuff.
yeah. So let's talk a little bit about Sonar, what we're seeing in Sonar. How is the freight market moving so far this week? I know we finished last week 4% above
Yeah.
week over week, and
did.
I think, was it 31% year over year?
Yeah, so, yeah, 31% year over year, which is excellent. So outbound tender volumes are sitting. I mean, they're still very, very strong. And the interesting thing about it, they're sitting at 13,553 today. So
OTVI?
The OTVI or the tender volumes, which is indexed, and that's extremely high, obviously.
Yes.
It's the highest we've.
I mean, it's a record.
It's the highest we've ever seen
Yeah.
since it's been there, and it's holding steady with a nice steady increase. Which tends to give a lot more strength to the trend, right? It's not this rocket ship up. It's not this blast off. It's been a nice climb since before Memorial Day, actually. It's been a nice climb, and now OTRI, or the tender rejections capacity, is tightening. It's sitting at 21.1%.
I think we finished the week about 19
about
and
19,
change.
so it continues to go up. So pressure on spot rates is up, capacity is tight.
So 1 out of every 5 loads that are electronically tendered out there are being rejected right now.
Did you cheat? Did you use a calculator?
I didn't. I didn't. So the Oklahoma math right there.
Excellent.
In 2018, we all remember 2018, very hot market, high capacity. We were somewhere around 25% on a natural average.
We were, but that was early June.
Yes.
That was June 28th was that peak at 25%. Year over year, same date, we're 16.35% higher than 2018. 2018, everybody thinks of 2018 as there's the benchmark. It was really 17 into 218 in the lead up into that midsummer peak. But the second half started to drop off. So we're way above 2018, 2019 in both volumes and tender rejection as far as capacity is concerned. And there's really nothing out there that shows that it's going to change. I'm watching the maritime imports, which are all, volumes at Port of Los Angeles, Long Beach, Elizabeth, Savannah. They're all up in the weekly change. Only 2.2% in Long Beach, Los Angeles, but Elizabeth and Savannah are up in double digits, high double digits. I mean, like 15, 20%. Up type of stuff. And the year over year change, you've got Los Angeles, Long Beach at 7.2% up, EWR's 30% up, and Savannah's up 14.8. It still looks fairly good.
It does. I think a lot of that has to do with the economy. And luckily, I think we have our chief economist ready to give us his insights on why freight volumes are so strong right now. So, Anthony Smith, what's your take on this?
Well, I think one of the first things that we're looking at and the latest trends we're looking at the macroeconomy has always been a hot topic issue as of late is manufacturing. And when we've seen from manufacturing with the latest ISM numbers, we did see that it increased or maintained above 50 reading for the third consecutive month. And so what we saw from the ISM PMI in the most recent month was a 54.2. And so that shows, it designates that there is expansion within the industry. But again, this is not going to be widespread throughout each individual component of the industry. You're looking at chemicals, it's going to be different from transportation, which is going to be different from computers and electronics. So each industry within manufacturing is going to be impacted a lot differently. And the biggest thing is that jobs aren't coming back fully. And when we're looking at these indices, it's important to remember that these are diffusion indices. And so these are basing it off of the month before. So even though it's at a 15-month high, it doesn't mean that manufacturing production is at a 15-month high as well.
So is this the signs of a sustained recovery in the in manufacturing, do you think, Anthony?
It's definitely a positive sign. I mean, when we're looking at the new orders component, that's one of the areas I like to look at for any kind of forward-looking indicators. That's up 61 to 61.5, so now in the 60s. So that's indicative of more activity coming down the pipeline. But again, it's better than it was last month, and that's the main takeaway to really kind of get from these indices, as diffusion indices like the ISM PMI. And when we're looking at that, it can be a little bit misleading, but it is encouraging to see that this is moving up on a month-to-month basis. On the contrary side of it, construction spending has declined on consecutive months. And so both of these industries have really tight ties to flatbed trailer volumes. And so when we're looking at what's going to be impacting that sector, what's going to be impacting those equipment types, it's going to be primarily manufacturing and construction spending.
Yeah, it's interesting. When we look at the outbound tender volumes and the rejections, it's the flatbed that's kind of lagging, just kind of sitting there. It's not shows some signs of life every once in a while, but it's not that great. Even rail car, when you're looking at chemicals and some other products moving rail car that are indicative of strong economic growth, there's sign there. They're not dead, but it's not super strong, right? But Anthony, it's what are the headwinds? What are we looking at here?
Sure, I think on the manufacturing side, some of the major headwinds, of course, are going to be any kind of spikes in cases. Some industries are just going to be permanently impacted. Some of the respondents mentioned that there's going to be a struggle with jobs coming back online, and they're still nowhere near pre-pandemic levels when it comes to production or employment levels. So that's going to be a major headwind for manufacturing. On the construction spending side, there were headwinds before COVID-19 that came in the forms of supply side constraints. And so you can only imagine how that's being amplified in the current environment. So we're looking at construction spending and the environment for construction. There were limited lots available for builders to kind of operate on. There are supply side constraints when it comes to materials. And a lot of those supply side constraints really got exacerbated here with COVID-19 when we look at the amount of complications from the supply chain for construction materials. When we're looking at construction spending, the largest part of it is going to come from that residential side of construction. And that was one of the areas that also declined on a month-to-month level. And so we see in the latest report that there was an expectation by many for an increase in residential construction spending, but that fell 1.5% throughout the month of June. Another major headwind, of course, is going to be a potential decline in those that are looking to be first-time home buyers. Of course, with a lot of uncertainty for many throughout the country and throughout the world, but when we're looking at the U.S. throughout the country, as opposed to having any kind of job security or income stability. So that's going to be two major headwinds for construction spending, and when we're looking at manufacturing, both have headwinds. We have manufacturing, again, looking like it's expanding, increasing on a month-to-month basis. But just because we're at a 15-month high doesn't mean that production is at that 15-month high, because this is, again, a diffusion index. And we're looking at construction spending that is a little bit lagging, and we are a little bit, I'm at least a little bit optimistic about the construction sector in the coming months and weeks as we kind of start to see a little bit more activity kind of be facilitated on that side of things. But again, it's all going to come down to the path of the virus. That's really going to dictate how far or how fast the pace of recovery is for many industries. And again, it's going to be a piece-by-piece sector when it comes to manufacturing. And when it comes to construction material or construction spending, that's going to be on a state-by-state and even county-by-county basis. So things are going to get a lot more specified here.
Did you say you were optimistic on the construction sector coming up?
I am optimistic about the construction side. Again, it's going to be dictated on the path of the virus, but before COVID-19, we did see that there was a lot of pent-up demand, and some of that pent-up demand was starting to kind of come back online. For those that have been able to retain their positions, that have been able to work remotely and social distance, I think they are still looking for homes. And what we're looking at, the amount of existing homes, for example, a lot of those are really in tight supply, and so the inventory levels have dropped. So we're still seeing pretty sustained housing prices because of that. Again, there's going to be many different realities for Americans throughout the country. When we're looking at those that have been unable to retain their work or not able to retain their jobs. There is a huge threat of eviction throughout the country, and I think that's going to be another issue that we're seeing in the coming weeks and months here in the latter half of 2020. But when we're looking at those that have been able to retain their jobs and social distance and work remotely potentially, I think they are still in the hunt for a good deal. It's just that the supply side constraints and those tight inventory levels are definitely going to keep prices high. And we're looking at freight volumes, of course. We're looking at existing homes. There's going to be a downstream effect when we're looking at consumers filling those homes with new goods and products, whether it's furniture, electronics, appliances, and things like that. That might also come into factor when we're looking at more and more Americans looking to get into their first homes, whether it be a starter home or an investment home.
Thank you very much for your insights today, Anthony, and we will see you again on Thursday when, of course, the initial jobless claims and continued claims come out. It's something we track very closely here at FreightWaves on the health of the economy.
Yeah, I mean, the path of the virus, where it goes, what do we get out of this next stimulus?
We will see. We will find out very soon.
That's
I think.
the angst, right?
It is the angst, and I don't think anyone really has really good answers.
No.
But when it comes to supply chain, I know someone who has really good answers on how to analyze that, and that's Richard Sharpe.
I was going to guess that.
I know, right? The CEO at Competitive Insights, who's joining us right now via Skype. How are you doing today, Richard?
I'm doing great. Thank you so much for having me on the show.
Well,
hey, welcome, Richard.
Thank you for joining us. Can you give our audience a bit of background on Competitive Insights and what you guys do over there?
Absolutely. We are focused on providing very specific, accurate, and repeatable information on the profit and cost associated with every SKU sold to every customer through every channel. And we do that by taking native transactional data from the sourcing of the product in China to the final end delivery. We go through a validation process to ensure that the organization has confidence in the information, and then we create that on a repeatable basis on both cost and profit in order to solve problems such as supply chain risk, SKU rationalization, product segmentation, a variety of different supply chain related issues.
So what's the most common thing that you see in your customer supply chains that goes unnoticed, or maybe their biggest challenge?
Well, the challenge is always visibility. They first start with thinking that their data, because it's in multiple places and has gone through a series of different transformations, it cannot be trusted. But once you get through that, then it's the visibility associated with performance. So let me give you a quick example. A $5 billion operation out of Chicago, serving 110,000 delivery locations, a very complex DC network, serving both wholesalers, distributors, and direct to their customers. Out of 110,000 locations, how many would you believe gave them 80% of their profit? 110.
110,000?
I will go with 24 of them.
What? Is it 24% or 24?
I was going for the exact number.
Well, it's 110,000 locations. Is that what you said, Richard?
110,000.
110,000. So how many drove 80%?
22, 23.
Just 20. I'd say 684.
Oh, 200,000 is what I meant. Sorry.
200,000?
Or 200.
200
Yeah.
or 2,000?
Yeah.
Okay.
Let's go with that.
You're just picking random numbers now. But
Well, of
Richard,
course, I don't know the answer. He's the expert.
Oh, that's funny. So most people would say the 80-20 rule. 20%
Right.
of 110,000, right? That would be a compliment. The actual answer was 2,383 out of 110,000. What does that mean to supply chain? When they saw that their unprofitable and marginal customers were getting the same level of service as their very profitable customers, that made no sense. And they changed giving everybody next day delivery to a different service program based on their margin contribution. They dropped $3 million from the outbound transportation budget immediately. That's why visibility matters.
It is why visibility matters. It's why the Pareto rule that we talked about offline a couple weeks ago really matters, and you find that everywhere.
Absolutely.
So that was about if I have my numbers correctly, that's about 1.5% to 2% of those locations drove 80% of profits or to the bottom line, right?
Right. It's about 2.4%. Yeah.
2.4%.
Wow.
Okay.
And
That's amazing. What's the most common cause of that, Richard? I mean, how does that happen to a company?
Well, it happens for a variety of different reasons. It can be any of the costs associated with the product itself. It can be obviously sourcing costs, tariffs. It can be the way they're actually storing the inventory for the product. But it can also be on the revenue side. It can be discounts that are not aligned with the associated selling price. It can be a variety of things. That's why it's really important to have a true and accurate and specific total cost curve for every customer, for every product, because you're going to find that the reasons for those kinds of performance changes are a variety of different reasons. You have to really deal with that very quickly.
That's interesting. I would suppose you find a lot of kind of pushback sometimes when you present some of these findings and some of your suggestions to some of these companies, or might get into arguments or maybe a discussion of whether your data is telling the right thing, et cetera. What are some of those type of discussions that you have with these companies? Is there pushback from them when they see this, because they're going after growth and growth and growth, right? And there's always this argument, from the sales side. That, hey, they're profitable here, but they're not profitable there, but we can't get the profitable without the non-profitable, that type of stuff. Richard, you run across that a bit?
All the time. That's an absolutely great question. And so what you want to be able to do is you want to be able to give them specific information. If you have the argument that I have to have product A in order to sell product B, but product A is only being bought by unprofitable customers, the argument tends to go away. So when you can really demonstrate it based on a financial performance and it's fact-based and the organization has confidence in the data, the arguments are there, but they can be managed.
And I think it's a tough pill for any installer that you need to cut down your customers or cut down your vendors, but especially cut down your customers
in my previous
to improve profitability, right?
In my previous job, it took me about 4 months to convince our CEO to cut about 10% of our top line revenue and to improve our operating ratio. When we finally did it, it was amazing. The turnaround, it was along the same thing as Richard's talking here, not nearly as in depth of analysis.
I'm sure Richard has those same conversations whenever he comes in and presents. Is that kind of the common scenario?
Yes, absolutely. Let me give you another example that's really associated with risk and what so many companies are going through with the impact of COVID. One of the very first things that one can do in order to be able to retain cash and improve profitability, let's say you have a little over 1,000 different customers. If you knew that 31 of them were basically costing you $8 million of operating expense, but were leaking $2 million in profit, would you do something about that?
Yeah.
I think so.
Absolutely. It immediately has a positive financial impact on the bottom line.
Yeah,
They really
unbelievable.
do.
Hey, Richard, you see a lot of companies in different spaces that are growing at all costs, right? With the the investment capital. Oh, well, we'll be profitable in 10 years or 5 years or 6 years, that type of stuff. Is that something you run across quite a bit, or I mean, that hey, we understand that, but hey, we've got to grow at X amount and run this revenue up. It doesn't profitability right now doesn't matter to us.
Michael, it's a great question. The answer is we have seen a lot of that over the years. We've been in business for 20 years. But now with COVID and the financial impact that that's having on a global basis, now it's a game of precision. So they can't afford to wait 5 years. It has to be decisions that make sense tomorrow and the next day as these things change. So being able to have that kind of insight, making intelligent decisions. You may want to gain market share, but gain it smartly, as opposed to not having the insight you need to make smart decisions about products and customers.
So what would your recommendation be for any of the companies out there who say, I think we might have a problem, with profitability? We have some unprofitable business.
Yeah.
What's the first step to even starting to evaluate or going down a path of evaluating? What's the first thing that needs to happen?
The very first thing that needs to happen is that you need to go through a process where the data you're going to use to do those analytics is validated and trusted. Because if you go through this process and you actually say, look, let's look at these unprofitable customers, and to Michael's point, the salespeople or someone else says, I just don't have enough confidence in that data to make such a big decision, you've wasted your time. So the very first step, but let me offer, a lot of people will think, well, that's going to be a 2-year investment in data lakes or data warehouses. We're talking about time in matters of weeks to be able to get that to that level of confidence and then use that information smartly. The second part is to be able to tie it back to a gain in financial performance. So you say, okay, I know we had some resistance there. We got through the data issues. We made a decision. Look at the positive impact that's had on the bottom line. And then others in the organization will get on the bandwagon, because who doesn't want to be on a successful ride?
Very interesting. Richard, I don't know if you have any thoughts on this or not, but we were just talking about this yesterday. The manufacturer, I forget the name, the manufacturer of Oreo, cutting like 35% of their SKUs while their revenues grew, and their market share grew because of that. Have you run across that before in working with companies?
Absolutely. If you're smart, a lot of discussion around loss leaders, and we need to have product A and B, as we talked about earlier. But really being able to focus your resources on where it matters the most is a very smart strategy. If I may, let me just offer one other example of that. Say you have 800 finished goods suppliers around the world, and you know how much profit each supplier location is generating. You look at that and you say, we have a high-risk area here. They're in a country that we're very concerned about. So what are we going to do? Well, there's a lot of talk about nearshoring, reshoring, alternative sourcing, right, in order to be able to add resiliency to the supply chain. But what if I showed you out of those 800 products, only 51 gave you 80% of the profit from that supplier? You would focus your energy on that 51, right?
Yeah.
And then the supplier may be the next 51. So it really is around precision, having accurate information that's trusted, and making smart decisions.
Exactly right. Well, thank you very much for your time today, Richard. How does our audience reach out and learn more about Competitive Insights?
The website's a great place to go. It's www.ci-advantage.com.
Perfect.
CIAdvantage.com.
Perfect.
Beautiful.
Thank you for your time, and have a great day.
Thank you so much.
Thank you, Richard.
Thank you.
Mm-hmm.
Yeah. When it comes to trucking, one of the companies that we've done some research on and really talks about it in their earnings call, kind of this same philosophy is Old Dominion. And I think all companies kind of do it, but Old Dominion is very focused on profitability of each and every single customer.
Yeah.
And that's the reason why Old Dominion is a great company.
Yeah.
It really is.
If you're looking for an argument, you got the wrong guy.
All right, I'm not.
I'm with you. Who we got up next?
We have Eric Kulisch, who's our air cargo markets editor.
Excellent.
joining us via Skype right now. How are you doing today, Eric?
Hey guys, doing great. Thanks for having me on.
All right, we're not getting any audio from him
we
right
are
at the
not.
moment,
He's probably on mute.
You know, so trucking companies have got to be, it's very, very similar, right? It's just not SKUs. It's customers, it's lanes, et cetera, when you're doing those bids. Because and that's why I brought that up, because in LTL days, I had a cluster of 6 terminals, and I had one that's constantly operating in the 100, 100.5, 100, 101. Had a huge national account distribution center where the pricing just was terrible, but you had to keep it because it was profitable for the whole country, for the whole company.
Know, right? I can tell you story after story.
That type of analysis is huge.
It is huge. It is huge. And we'll talk about it right after we talk to Eric Kulisch here. Eric, are we up and running now?
Can you hear me now?
I can hear you perfectly. How are you doing today?
There you go. Doing great. Thanks for having me on. Beautiful weather out here on the West Coast. So I hear it's pretty hot where you are.
It was. It cooled down, but not like the airlines cooled down, right? over the last the last few months. So
it's been a cool down.
I know, right? So what are the main takeaways that we should know about the air cargo market right now?
Well, it's as it's been for most of the year, it's pretty volatile, and it's just so much uncertainty. Of the big drivers, what's happening with the passenger airlines is kind of they kind of set the benchmark for everything else to follow, because so much of the cargo capacity comes in the bellies of those planes. So the airlines are still mostly shut down. They're gradually adding some flights here as the fall and summer goes along, but it's still nowhere near where it was in 2019. So capacity is really short. And
the bookings are still, what are they at, Kevin, right now? I mean, you track those fairly closely. Are they still in
mid 20%?
Mid 20%?
Mid 20%.
As compared to last year?
Compared to last year,
and it was rising, but then it kind of tapered off, right?
I think it's tapered off. I haven't checked it this week. I'll check it right now. But okay. I think, advanced bookings or reservations, because you're buying tickets 2, 3, 4 weeks out, Did the airlines during this earnings season, Eric, give any expectations or what they're seeing or what they're expecting those bookings to be over the next few months?
Yeah, they did, Kevin. There was basically some, initial optimism, maybe exuberant optimism in, early June that bookings were up and cancellations were down, and, maybe things are going to be better than had hoped. But in the earnings calls, after that little blip, they've started to see some decline, like you said, in bookings and forward bookings, and the TSA security checkpoint numbers have kind of dipped over the last 4 weeks as throughput at airports, although that may not be the best gauge, but it is one metric. And I think this past weekend, it was a very strong weekend relative to the past. But the airlines have seen a bunch of, indicators that, this is going to be a long recovery. It's going to be a lot of, it's just going to be jagged up and down, right? You think you got some recovery. One part of the country or the world has some reopening of travel restrictions, then COVID flares up, it's back down. So I think they're still adding flights gradually, but not as many as they were anticipating for September and October. They're kind of pulling back a little to save money.
Yeah, Eric, you're talking about the fractioning, they're fractionalizing the markets, et cetera, in trucking, but also in air cargo, obviously, right? Because it's the passenger movement that then provides the capacity for the belly cargo to move. So bookings were kind of going up. We were waiting for this approval for domestic airlines to start putting packages and freight on the upper deck, or where the seats would be, or even in seats and cargo netted into those seats, et cetera. But then it came at a time when bookings were kind of up and things were good, and so there were comments from employees and operational employees, to be nameless, that we're talking about, wonder if we'll ever even use this because we're starting to come back online. Things have changed a little bit. Will they start doing that? Are they start talking about that? You had this article talking about Swiss Airlines cleared for more types of cabin cargo. Are we seeing that with other airlines? Are there other airlines going back to that thought early on in the crisis that they would start utilizing more and more of their passenger deck in addition to the belly to maintain at least revenue flows and moving things? And where are prices going to go? They started to drop down, right? Because we saw PPE start to, or at least the urgency of the movement to diminish as stockpiles went up. That's changing a little bit slightly now too, right? So
so let me fill you in there a little bit on that. So the pricing, softened a bit from the stratospheric levels it was at back in March and April and early May, especially coming out of China, which are the big trade lanes to the U.S. and Europe. And so they've dropped like 80% or so. They're still much higher than they've been in the past for this time of year, but kind of more normalized. But the last 3 to 4 weeks, we started to see those rates go up, especially China to U.S. I think they're up about 25%, and the thinking is they'll continue to go up. We expect some of the big tech companies like Samsung and Apple and Sony to release some new electronic products, so they will want to rush those to market and soak up a bunch of the freighters that are available. So that'll put pressure on everybody else to get capacity. Ocean prices, ocean spot rates are very high right now, so that's pushing some people to air, and air cargo is going up. But back to your point about the passenger freighters and using, doubling up on those planes as putting the cargo in the cabins and on the passenger planes. That's still going on strong for a lot of airlines. There was a little bit of pullback in that regard when the rates softened, or the cargo rates softened, especially on really long hauls like Trans-Pacific, because the fuel prices went up a little bit and the rates went down. The economics of flying some of those planes, since you can't fill it all the way up like a freighter, weren't as good. But it varies. A lot of the airlines are still doing that. As you mentioned, Swiss International, they've been flying. It was interesting. They were one of the first out, but they were only able to fly PPE in the cabin, and now the authorities gave them permission to put other commodities in there. And one last thing, I know you guys probably need to go. United Airlines, they beat a lot of expectations with their cargo revenue. It was way up over last year, like a 36% growth, and was like 27% of their total revenue, which normally cargo's in the 2, 3, 4% range for these airlines. So they really crushed it with these passenger freighters.
I do have a final question here, Eric. 30 seconds, a minute answer. Is there any murmuring out there or any chatter in the market that the initial bailouts for the airlines might not be enough? Is there any speculation out there?
Yeah. So I think, a few weeks ago or months ago, the airlines, U.S. airlines were saying, hey, we got the initial bailout. We're good. We don't want any more. We don't need any more. But now that you're seeing big layoffs coming in October when the CARES Act money runs out, tens of thousands of people being, given early packages or whatever. But now there's some reporting that the airlines are coming back or lobbying behind the scenes for some more aid. I don't know how popular that will be, so we'll have to see. But it sounds like they're going to want some or need some.
That's great. Great insights. Thanks for sharing with us your knowledge of the air cargo markets and what's going on. And you can find all of Eric's articles on FreightWaves.com and American Shipper as well.
Yeah, absolutely.
And personally, how do people reach out and contact you? To network or to be a source.
Yeah. No, I'm at Kulisch at FreightWaves.com, and I'm at Twitter at Eric Reports, and I'm on LinkedIn. So reach out however you want.
Great. Thank you very much for your time today.
Thank you, Eric.
All right.
Yeah, he's got another interesting story out there on FreightWaves.com about Qantas shutting down their Melbourne airport facility.
Yes, that came out this morning.
Yeah, as the government there tightens down under COVID, which is going to
Yeah, and every
Really
Sunday
disruptive.
morning on FreightWaves.com, he has a weekly article that wraps up the air cargo market for that week. Kind of gives expectations for the next week. Some of it's quantitative, a lot of it's market chatter between freight forwarders. So it's an excellent read every week on American Shipper and FreightWaves.com.
Absolutely. You ready for something good?
I'm ready for something good.
Awesome. Well, there's
There hasn't been really anything bad.
the virtual event next month.
There is this month.
It is.
It is this month.
Right,
It's
it is
August, right?
already,
August
right?
19th and 20th is the Carrier Summit.
It is, and it's going to be action-packed, and it's going to be awesome.
is.
It's a day and a half this time because it's going to be great. So, and the good thing is, you don't have to register, you don't have to pay. You show up, you learn,
Right
you
there.
network like crazy. There'll be a great Slack going on. I'm sure the Slack rooms will be on fire.
It has been
and it'll
on
be
our
awesome.
last two virtual events, or only two virtual events, I should say, that we had the Slack channel. It's been on fire both of those events.
Yeah, absolutely. In addition to that, something good. 41 states have seen their economies grow while reducing carbon emissions. So, according to the Good News Network, the nonprofit World Resource Institute credits improvements in vehicle emission standards, increases in lighting and appliance efficiency, a shift from coal to natural gas in the power sector, and the rapid deployment of wind and solar power. So, the 5 states that cut their local carbon emissions the most, despite federal policy, while still growing their economies, were Maryland 38%, New Hampshire 37%, the District of Columbia 33%, Maine 33%, and Alaska 29%. Massachusetts and New York businesses and homes cut their emissions by 25% while simultaneously growing their GDP by 26% and 21% respectively.
That is great news.
That's pretty impressive stuff. So the 9 states that did not reduce emissions while growing GDP, let's pick on them: Louisiana, Texas, Washington, Arkansas, Mississippi, South Dakota, North Dakota, Idaho, and Nebraska. The renewable energy industry in America generated, according to the WRI, $238 billion in revenues in 2018, and the sector's 11% growth in 2018 was almost 4 times the growth of the U.S. economy overall. So that's good stuff.
It is good stuff. It's really good stuff, and you can see sustainable energy go up all the, throughout the Central Plains, right?
And in
Oklahoma,
our
Texas,
industry, every
Kansas,
day we're
Nebraska.
talking about new electrification of.
We are, yeah. Yep.
I mean, Lordstown just got
Reverse merger,
$275
so they're
billion
going to be
or something
public.
like that with their
to
reverse
join,
merger.
Yeah, join Helion and Nikola, all
Nikola.
doing these reverse
Yeah.
mergers or SPACs and going public and ramping up product out there in the market.
Yeah, absolutely. Absolutely tremendous stuff. Absolutely tremendous stuff.
Yeah.
So as we said, let's see. So the FreightWaves and Seat My Trucks are excited to present the Carrier Summit on recruiting, retention, regulation, operational efficiency, and maintenance. Expect to hear from trailblazing trucking pioneers who have impacted the way we do business today and the way we will do business tomorrow. Get the latest updates on how truckload carriers are adapting to the new world we live in. You'll hear about driver management and training in a remote working environment, recruiting and minimizing turnover strategies, mergers and acquisition activities, and reducing downtime efforts. The 1.5-day event will be structured into 3 primary blocks: driver management, operational efficiencies, and maintenance. That's 3. I counted them on my hand. As always with FreightWaves virtual events, attendance is free and there's no pre-registration required. Come ready to learn for the best and experience what the future of the truckload industry has to offer.
It's going to be fantastic.
It's
It
absolutely gonna be
is.
hot.
I have a
And
segment.
hey, if you don't believe us, go back and look at the 3PL Summit
Yes.
at live.freightwaves.com or on audio by looking up the Freightcast on your favorite podcast, and you'll see.
Oh, yeah.
It's an incredible event.
I have a great segment with Andrew Burberg and Nate Robert from Baton talking about detention and solving detention. We're actually going to have Nate
That's gonna be
on
awesome.
the show Thursday to talk a little bit detention, preview our fireside chat that we did, all 3 of us did for the Carrier Summit.
Yeah.
That we'll have up and running in August 19th and 20th, right?
That's exactly right. What do you got on Great Quarter Guys?
Great quarter guys. We're not doing great quarter guys today.
Oh, we're not?
Andrew's out on
'cause
vacation.
Andrew's out, all right.
Yeah, so no great quarter guys this week. But tomorrow, I'm putting that coffee down.
Oh, yeah,
Dooner
okay,
and
good.
I welcome Chris Jolly, who's the freight coach.
The freight coach.
Yeah, the freight
awesome
coach. He's
stuff.
always giving really good advice, and
Yep.
we've been doing a lot of mainstream sales of late the last few weeks, which have been great. You know, the Real Wolf of Wall Street, Toby from the Morning Brew talking about social media, but we're returning back to our roots and talking about the guts of freight sales.
Awesome
You know,
stuff.
how to get accounts and transition those over to operations or carrier sales, and how to really sell and operate
Beautiful
loads
stuff.
on the board, just
Hey,
like
and
a real
if you
freight
missed
broker.
What the Truck yesterday, we covered the wildest Florida man story you've seen in a long time. 9 miles he rode on the hood of an ABF truck. But anyways, thanks for watching, everybody. Peace and love. We'll see you Thursday.